Welcome to the second step of 5-step trading. So far, we've covered the importance of original ideas and how to generate them. In this second step, we will show you how to investigate your ideas in more detail. To be able to do this well, you need to really understand the company. This involves finding out about their management and products and knowing in which countries they operate. You also need to try and estimate the value of the company, so you can then compare this to the value of the stock on the stock market. It sounds complicated, but luckily a lot of information is readily available for you to use. You just need to know what to look for. On a different note, we are not going to use real company examples here. It would take too much time and distract from the main goal of the 5-step trading program, which is to explain a process that can be followed again and again and hopefully form the basis of your investment process.
I'm Lex van Dam. First of all, congratulations. You've made it to step 2. Analyzing companies is a part of trading that scares most people, but not doing it will put your hard-earned money at risk. We will only look at what is really important, so we don't get sidetracked by small details. You will probably find it a little difficult to begin with, and that's normal. If you need to watch this module a couple of times to really get it, you would not be the only one.
In order to develop a level of confidence in the business that you wanted to make an investment, it's quite important to do your research. So looking at the company accounts, looking at maybe acquisitions that they may have made in the past, studying balance sheets, all just to give you an impression as to whether this was likely to be a good investment and in which direction you should be investing.
I tried to do as much research as I could on how the company is structured, who the key people are, their history, outlook, recent reports, etc., etc. But it's important not to fall in love with stocks. They won't ever love you back and they don't care. So I used to try and find reasons not to trade if something was screaming buy or sell at me, just to sanity check myself.
Well, basically, I tried to look at the company performance relative to its peers, and you can define peers in a lot of different ways, such as the industry they're in, how big they are, the market they sell to, and their underlying financial performance, and then you try and make judgments based on that. I also looked at reports in the press and elsewhere about management changes, although in practice, this element of the change in the price was probably already built into the price, and frankly I didn't have any internal knowledge about those companies to justify any different opinion anyway.
Really, if you're going to do fundamental analysis properly, what you want is to get some kind of glimpse into what might happen in the future. That's really why you're doing it, and that's why it's so highly priced and why people who are good at it are really fantastic at it. Because they go to companies and talk about issues like this, like you're saying, and don't come back and just say, look, the price of your t-shirt's going up next year. They tell you exactly how much it's going up and exactly how much it's going to have an effect on you and me, and then put all the information together and say, well, on balance, this is a problem, but it's not as big a problem as it's being made out to be. So, and the reality is, people are still going to buy t-shirts. So are we really getting this a bit out of kilter here? And the truth is that retail share prices have been completely smacked in the last 6 months. They are almost reflecting that one of these companies will go out of business. More fundamental analysis. If one of them does, that's great for all the others. And that's what they look for.
So before you invest your money, you need to do some research into the fundamental elements that define the company. To do this properly, you have to become a company detective. The best source of information on a company is the report they publish at year-end, called the annual report. Often interim reports are produced as well. As you become more experienced, it's fun to look through these reports in an attempt to find not only what is included, but also what is not included. You will find that although company management normally tells the truth, They often hide important information. So never be naive when you look at a company. By the end of this module, you will have a lot of tools to help you decide whether a company's stock looks expensive or cheap.
To understand a company properly, you need to look at it from 5 different angles. The first angle is the management of the company. Get to know the person who runs the business, and you will learn a lot about the business itself. Look at their background and their historical track record. Are they the right person for the job, or is new blood needed to take the company forward? You also need to understand the products and services the company provides. Is it a unique product, or can new competitors easily enter the marketplace? Here you need to get a real feel for what the company actually does. The third angle is the financial health of your chosen company. Here you look at the financial situation of the company. How high are the sales? What are the costs? Is there a lot of debt? This is the data that helps you understand what kind of financial shape the company is in. The fourth angle to address is the stock market valuation of the company. You need to find out how the market views the company and then compare that to your own value estimate to see if there is a trading opportunity. And last but not least, it is very important to understand the geographical split of the company's costs and its sales. This also means you have to start thinking about exchange rates. To illustrate, we're now going to look at each of these 5 angles for a fictional business called Cakes for You.
So the first thing to look at is who runs the company. He or she is the face and the brains of the company. And as they are the key person, you need to try and find out as much information about them as you can. Cakes for You was established 15 years ago by Jeff Jones. It's important to find out how much of a vested interest he has in the company.
Well, when I founded Cakes for You 15 or so years ago, I owned the entirety of the company. I owned 100% of the company. But because the company has expanded so rapidly now and there's so much demand for our products, I've had to actually go externally to fund some of the growth. So now around about 65% of our shares are in the hands of large pension funds. Another 10% are owned by small shareholders who love to come to our annual general meeting based in Liverpool, where we serve a range of our latest slimming cakes, which are always very well received.
So do the math. He used to own the whole company, but had to sell 75%. So he now owns 25% of the company. This means he still has a lot of vested interest in the ongoing success of the company. And that's a positive factor for the stock. The person who calls the shots will be looking out for his own investment, which will benefit you as an outside shareholder. This kind of information is very easy to find in the annual reports or from the internet. So without too much effort, you can have a basic understanding of who runs and who owns the company and their background and experience.
So, you now know who runs the company. Time to look at what the company produces. Let's hear again from Jeff Jones.
Cakes for You was established around about 15 or so years ago. I'm a former executive from Unilever, and I'd long thought about the idea of trying to come up with a product which was very, very tasty to eat, but also allowed you to lose weight. And I came across the idea of these cakes, and Cakes for You was founded.
No matter what company you look at, it will be very important that they produce a strong product in terms of quality and sales. You also need to look at the strength of the brand and the competition. There is no magical formula that tells you how much you need to know about a company's products. Use your intuition, but in general, while it's useful to know a lot, you can never know everything.
So let's put our fictional company's product under the microscope. Cakes for You produces a range of cakes that make you lose weight. They sell under the brand Slimming Cakes. The company is based in the UK, but sells its products globally. The market for weight loss cakes is totally dominated by Cakes for You. They invented the concept and have a first mover advantage. They still have a global market share of 90%. Knowing the size of a company's target market and their market share are important factors in estimating their potential growth rate. The weight loss cake market is extremely profitable, which means that other entrants are likely to appear at some point, and other global cake companies might introduce their own slimming varieties. This might represent a threat for the future on one hand, But it also means that other companies will start marketing slimming cakes, which might help increase the overall market. So although Cakes for You market share might fall, they will still be selling into a larger overall market.
A company with a good product doesn't necessarily make for a good stock though. It's only one of the factors. So don't fall in love with the company just because they sell cool products.
So back to our fictitious company, Cakes for You. How healthy does it look from a financial perspective? How much money does it make for its shareholders? Is it sensibly capitalised, or does it have too much debt? Is the dividend payout appropriate for the level of profitability? We need to perform a diagnosis to ensure we understand the financial situation the company is in.
The ultimate goal of analysing financial data is to identify differences between what you think a company is worth and what the stock market thinks. You should aim to buy stocks where the stock market doesn't realise their true potential, so that you can make money while the stock market catches up with your opinion. And you want to sell stocks where the market doesn't realise the actual shortcomings.
So let's open up those financial reports. The number to focus on here is the profitability of the company, or the earnings. Investors like companies with strong growing earnings, and the stock market likes companies with earnings that beat expectations. When the company reports earnings that are higher than expected, you should expect the share price to head higher. And when the earnings are disappointing, the stock normally trades down. So earnings are clearly very important. The earnings for a company are calculated in what is called the income statement. Here you find the value of the company's sales. To find the earnings, you deduct costs and expenses from these sales until you end up with the bottom line, i.e. the earnings. Let's look at Cakes for You. As you can see, Cakes for You sells £100 million worth of cakes. It costs £30 million to manufacture them. This means that Cakes for You makes a gross profit of £70 million. However, the company has a lot of other costs as well. Here you can think of salaries, rent, utility bills and marketing. These costs add up to £38 million. The gross profit of £70 million minus the £38 million of other costs gives you the operating income, which is £32 million. When you then deduct interest, expenses and tax, you end up with the earnings. Cakes for You pays 7% interest on the £100 million debt that it has borrowed to finance its business. The tax bill is just over £10 million. As you can see, the total profit for shareholders is £14.64 million. So, as you can see, it's actually a lot simpler to calculate a company's earnings than you probably thought. And as we just saw, if you divide the total earnings by the number of shares the company has outstanding, we come up with the earnings per share, also known as EPS. That is 14.64 pence of earnings per share, giving a total profit of £14.64 million and 100 million shares outstanding.
Well, I'm very pleased to say that we had another very decent year. We had a rise of 10% in earnings last year. So we're making around about 14 pence a share now in earnings, and actually we're selling £100 million worth of slimming cakes per year now. The gross margin, the margin that we make on that, is actually 70%.
In practice, only a few people will go through the whole income statement to calculate the earnings themselves, as the earnings of companies are widely published. And on top of that, investment analysts usually publish their predictions for future company earnings as well. Even though any individual estimate is unlikely to be spot on, the average should give you a good indication, and we call this average the consensus earnings expectation. You can actually quite easily try to form an opinion on the company's future earnings capability yourself. Try it by looking at the historical earnings of the company. If the company earnings have grown 10% every year for the last few years, and the economy is stable, then the chances are that the earnings will go up 10% again the next year. But if you have a view on the economy for next year and think that the economy will slow down significantly, then you should probably conclude that the company earnings will grow less than 10%. Earnings from year to year sometimes can be hard to compare when there have been exceptional circumstances, such as the closure of a large factory. While this would affect the earnings in the year it occurred, it would not be something that happened every year. To compare earnings from different years more easily, you should look at a measure that excludes these one-off items. We call it the earnings after extraordinary items, or earnings ex items. The last thing to look at is the dividend. This is the cash payment to shareholders as a reward for investing in the company. Cakes for You has the policy to pay out 50% of the earnings in the form of an annual dividend, which for this year is 7.32 pence. We ideally like to see a dividend that is going up a little bit every year and that is affordable for the company. There is no point in getting paid a high dividend if the company is losing money. So now you know how to read an income statement. The next thing we look at when doing our financial health check is the balance sheet. Whereas an income statement is a measure of income over a time period, a balance sheet shows a snapshot of the financial health of a company at a certain point in time, i.e., it is static as opposed to the dynamic income statement. Let's look at the balance sheet for Cakes for You. On the left-hand side, it shows what the company owns, and on the right-hand side, what it owes. As the name suggests, it always has to balance. OK, what does Cakes for You own? It has £10 million of cash, and there are invoices outstanding of another 20 million, which are due to be paid by clients within the next year. Together, this is £30 million and is called the current assets of the company. Cakes for You also bought a little company a few years ago and paid 10 million more than the value of the assets of that company. This is called goodwill. It has buildings and tools worth 105 million. None of these are easy to sell quickly, and that is why they are called non-current assets, and they total £115 million. In total, all the assets of the company together are worth 145 million. However, Cakes for You has some debts as well. Some are short-term, in the form of notes payable, and there is also a tax bill due of £20 million. They add up to £50 million and are called the current liabilities. There is also £70 million of long-term debt outstanding and some currency derivative contracts valued at £10 million. All the liabilities together add up to £130 million. If Cakes for You were to sell all its assets and pay all the debt with the proceeds, there would be £15 million left. This is called the book value of the equity. Note that this book value is not the same as the market value. The market value is the price of the stock times the number of shares. In this case, £120 million. The Academy website will give you more information if you are finding it hard to follow all this.
You need to be aware of a few more items that can appear in a balance sheet. For example, companies have retired employees who receive pension benefits. Sometimes the total of all these future pension payments can actually be a significant portion of the company's earnings. If you simply looked at the company's earnings, you would completely miss this. So the business itself can be great with fantastic earnings, but the pension liabilities can still destroy a company. Luckily, by law, the company has to show these obligations on the balance sheet. So always check the pension liabilities of the company. Another thing to watch out for is that the balance sheet often contains a line called Other. Management might not tell you what this is, claiming it to be confidential, but it might just be more convenient for management not to tell you. It might be worth trying to find out what this other line really means. Okay, so now we've done quite a bit of detailed investigation. We checked the company's management and we know all about the product. And we've been through the income statement and the balance sheet. So what's next? It's time to look at the fourth angle and try to value the company. To do this, we use the best value estimate we have available, the price of the stock on the stock market.
If we compare the stock market price of the company to its earnings, we can calculate how many times earnings the stock is trading at. It is called the price earnings or PE ratio and is the main stock market valuation indicator that we will use. Let's compare two scenarios. In the first scenario, the stock price is 10p and the earnings per share are 2p. This means that the price to earnings ratio is 5. If you buy a share in this company, you have to pay 5 years of earnings for it. In the second scenario, the price of this stock is now 20p. With earnings still at 2p, it means that the PE ratio is now 10. That is twice as expensive as in the first scenario. The higher the PE ratio, the more expensive a stock is. Cakes for You is trading at 120 pence, and the earnings are 14.6 pence per share. It is trading at 120 divided by 14.6 times earnings. That's just over 8 times.
Obviously we like to buy cheap stocks, but sometimes there's a very good reason why a stock is trading on a low PE ratio. For instance, if people expect earnings to fall significantly next year, the stock might not be so cheap after all. So as well as looking at the earnings the company makes today, you also need to think about the earnings the company is going to make in the future. This is why some people look at forward PEs, or the PE ratio calculated from next year's estimated earnings per share.
To make all this a bit easier, Lex has developed a model that should help you find a range of target prices for the stock you are looking at. It uses historical price data and earnings to calculate historical PEs. That is the valuation at which the stock is historically traded, and thus what the market has been prepared to pay for it in the past. When you combine this with an earnings estimate for the next year, it will help you find a lower band and an upper band for the stock price. Let's look at Cakes for You again to illustrate what we're trying to say. Say Cakes for You has grown its earnings by 10% over the past 4 years, from 10p 4 years ago to 14.64p this year. Cakes for You's earnings for the past 4 years can be shown in a nice upward sloping graph like this. Cakes for You's stock price has been trading within the following levels for each of the past 4 years. Note that 4 years ago, the high on the year was 100 pence and the low 90 pence. This year, the stock has traded between 110 pence and 120 pence. So we can then draw a line for the maximum price for each year, the top line, and a line for the minimum prices, the bottom line. If we then take the historic high and low share prices for each year that we saw in the last table and divide these by the earnings per share for each year that we saw in the first table, we get 2 ranges of PE ratios, a high range and a low range. So this is the maximum and the minimum PE a stock has traded at over the last 4 years. 4 years ago, the stock traded at a PE of between 9 and 10. This year, as high as a PE of 8.2 and as low as a PE of 7.5. This is the information we need to plot the high PE range and the low PE range. Let's see what it looks like. Over the past 4 years, the stock has traded on a PE ratio as low as 7 and as high as 10. So if we can estimate the earnings for next year, we might have a good idea what a fair price range for the stock could be. Let's say it has another year of 10% earnings growth for Cakes for You. That would make the expected EPS about 16 pence. Putting that on 10 times earnings makes 160 pence, and a 7 times multiple would give you a price of 112 pence. So, let's plot that expected future price range when earnings go up 10%. Again, the next year price of 160 is a PE of 10 times earnings of 16p, and the next year price of 112p is next year's earnings of 16p on a PE of 7. So when Cakes for You trades near 112, You might think it is a good buying opportunity, and when it gets to 160, it looks like a good sell compared to history. Currently, it is at 120, which is near the lower end of the range, and possibly a good entry point. So when you know what the historical PE range was, and combine this with next year's earnings expectations, you can calculate a fair value for the share price today. As if that's not hard enough, sometimes the situation can become more complicated. For example, what would happen if there were to be a breaking news story that the slimming cakes could cause cancer? If true, this might well cause earnings to drop. So is 112 pence then still a good level to buy this stock? Let's say the impact is a drop in earnings of 20%. This would make earnings of about 12 pence. Putting that on 10 times earnings gives 120 pence, and on 7 times a stock price of 84 pence. So the current stock price of 120 would be a great level to sell. On top of that, this cancer scare might seriously threaten the future of the company, and perhaps a multiple range of 7 to 10 times is now perceived as being too high. Maybe 6 to 8 is a more likely range going forward. That would equate to 72 to 96 pence a share. That would make 112 pence suddenly a great level to sell. So, whereas a day before that announcement, the expected earnings were 16 pence, and you might want to pay a multiple of 8 on it, making a fair value of 128 pence, the day after the scare, the expected earnings might be 12 pence and a multiple of 6, giving a price of 72 pence. The difference between 128 and 72 is over 40%. Even though this analysis is quite basic, it is a good way of finding a valuation for stocks. So let me summarise how you might identify a good level where to buy or sell a stock. You first look at the past earnings and multiples where a stock has traded. You then try and estimate next year's earnings, either yourself or by looking at analyst research. This gives you a range where the stock should be trading. Then compare this target price range with the stock price today. This will tell you, from a valuation perspective, whether we are in buying or selling territory. If the stock is in the middle of the range, you should wait until it gets to a price where you are comfortable owning it. This might not be at the absolute PE low, but hopefully close enough so that you could make some good money.
To help you make an informed opinion, I suggest you also look at valuations of competitors to see if the stock you are looking at is indeed cheap, or if you are better off investing in a competitor. Also, take a look at the broader market and the PE ratios there. If stocks in general are trading at expensive levels, it might be unrealistic for you to be able to buy your stock at a very low price. We've covered a lot of ground, so don't worry if you need to go back and watch this again. But I now want to take you to the last point left on our checklist. The fifth angle focuses on the geographical breakdown of the company. Where does it make its products? And where does it sell them? Does it need foreign products itself in its manufacturing process? If it operates globally, it's exposed to foreign economies and exchange rates that will impact the earnings. If there are two very similar companies, one selling a product in Greece and the other one selling a very similar product in China, which do you think should have the higher PE ratio? Probably the one that is exposed to the economy with the highest growth rate.
We're based in Liverpool. 100% of our products are manufactured in the UK. We're a very UK-centric company, but actually we export 90% of our products around the world. Now obviously this leaves us quite exposed to the sterling exchange rate because our costs are based in the UK, are sterling, but our revenues come in different currencies from around the world.
Companies are a lot more global now than say 20 years ago, and the international mix has moved to Asia. This might be perceived as good when there is growth in Asia, but could be a negative when the economic cycle turns. Let's go back to our fictitious company. Cakes for You exports 90% of its products equally to Europe, the Americas and Asia. All the manufacturing takes place in the UK, so there is a currency risk to manage. If a company sells a lot to Europe, They will end up with a large proportion of euros in their bank account. If the euro then strengthens, the company will benefit, as it means more sterling on the bottom line. The table shows that as euro/sterling moves from €2 per pound to 1.5 euros per pound, the profits of 1.5 million euros go from 0.75 million sterling to £1 million. This is an extra £250,000 on the bottom line. But if the costs are in euros and the sales in the UK, it is exactly the opposite. Let's summarise what we know about Cakes for You and what questions might need answering. It's run by Jeff Jones, who founded the company and is still a large shareholder. He seems a high-calibre businessman, but does he have the qualities to take the company to the next level? And what about the other shareholders? Are they buying more stock, or are they starting to sell their holdings? Cakes for You makes slimming cakes, a market that it has developed itself. It has a 90% market share, but how likely is it that a strong new competitor will appear in this fast-growing niche market? And how large could the total market become in the next few years? We know the company makes 14 pence per share, which is an increase of 10% on last year. The company is profitable, and its financial situation seems robust, enabling it to pay out a healthy dividend. But what would happen if, for example, the price of wheat doubled, and thus the cost of flour increased considerably? Would it be able to pass this cost on to the consumer, or would it hit the earnings? This is something you might want to consider. We also know that the stock is trading at 120 pence, which is about 8 times earnings. This is the lower end of the 7 to 10 times historical price earnings range, so it might be well worth buying. However, we also know what might happen if earnings were to disappoint. And at what valuations are similar food companies trading? We heard that Cakes for You has its head office and factories in Liverpool, but sells 90% of its products globally. This means we have to monitor the movements of sterling. If sterling goes down, that would keep the product competitive and help earnings. But if sterling goes up, then this might really hurt the business. Or has Jeff Jones hedged the risk in the currency market? All this is important to understand. Having checked all 5 angles every time before you enter a new trade will ensure that you are able to react rationally when important company news comes out. This will help you not to panic unnecessarily, but also ensure that you know when it really is time to sell the stock immediately. We are now getting to the end of step 2 on company analysis. We have shown you how to evaluate a company. There was some fun analysis involved, but also some more difficult material to get through. Of all the points on our checklist, we have spent the most time analysing the financial health of the company we are about to invest in. This is for a good reason, because just as with traders where risk management is key, for companies their financial management is crucial.
Where the analogy doesn't break down is that the price of a stock is a reflection of the full value of the company at that time. And that is what the fundamental analysis is trying to do. It's trying to understand what the actual value of it is at this moment in time. Now, how do you do this fundamental analysis? Well, we've already talked about one way of doing it, which is to look at your company versus just putting the money in the bank. And the whole point of equity is it's different to debt in that you're supposed to get exposure to the upside of the company if its performance is very good. If its management makes the assets grow faster, makes the workers work harder, sells the product to more people, or any version of those things. And that's your equity upside. And so that's why you buy shares.
You'd also look at the directors and who was leading the company and the performance of those directors, whether in that company or in previous companies, so study their career. But what I was particularly drawn to was whether the directors were making investments and the kind of investments that they held in that business, and also when they made those investments, how the market reacted to that.
I think that you have to look at the earnings of companies to see if they actually make money. I like to do company or fundamental analysis because it gives a good snapshot of the state of health of a company. I used to try and focus on a number of the key ratios and have a look at the balance sheet. But you have to look at these in the context of what the company does.
And then through reading media reports, not only about the company that you were planning on making an investment in, but also about their competitors and what the state of the marketplace around that company and that sector was. So all of this would help you to decide whether this was a share that you wanted to invest in and also the direction that you were likely to invest in it.
Company analysis is part of the story and needs to be used in tandem with charts, in my opinion.
You have to look at some financial numbers to understand the financial health of a company, because your money is at stake and you want to make sure the company is competently managed. However, as well as understanding the financials of the business, you need to be aware of the many other events and catalysts that could influence the company. Issues such as the political and regulatory climate and how this might impact the company can be very important. Be aware that companies are not static though. They change their strategy and buy and sell business divisions quite frequently. Your job is never done.
And here is a quick reminder of some of the things you have learned in step 2 of 5-step trading.
Analyzing companies is a part of trading that scares most people, but not doing it will put your hard-earned money at risk.
The first angle is the management of the company. Get to know the person who runs the business, and you will learn a lot about the business itself. You also need to understand the products and services the company provides. Is it a unique product, or can new competitors easily enter the marketplace? Here you need to get a real feel for what the company actually does. The third angle is the financial health of your chosen company. Here you look at the financial situation of the company. The fourth angle to address is the stock market valuation of the company. You need to find out how the market views the company and then compare that to your own value estimate to see if there is a trading opportunity.
The fifth angle focuses on the geographical breakdown of the company. Where does it make its products? And where does it sell them? Does it need foreign products itself in its manufacturing process?
Step 3 will show you how to master the art of the chart. This is meant to confirm or reject your company analysis and, where needed, help with the timing of your trade. Most people love learning about charts, so the next step should be fun.